Good afternoon, and thanks to everyone for joining us for our first ever AIS Virtual. While we miss being with you in person, we hope you find today's content both informative and useful in your decision making. Our core program this afternoon includes 3 sessions, will last about 90 minutes, and will immediately be followed by a virtual Meet the Experts, where our actuaries will answer questions for another half hour or so. All of today's content and more will be available on NCCI.com later this afternoon. But let's get started with our first session and NCCI's President and CEO, Bill Donnell, sharing his thoughts on our workers' compensation system and the decade ahead. Bill?
Thank you for joining us. This is a very challenging time for everyone. Many have told me that industry needs perspective right now, and my hope is that today's virtual AIS provides you with just that. You'll see your favorites, including the State of the Line and Bob Hartwig's economic view. And for my part, I'll touch on 3 things. First, where we are with the coronavirus. Then, a brief look at the performance of the line. I acknowledge that it's changing every day, but looking at past performance will help drive one of my key messages for today. And we'll summarize some of the critical issues in the workers' compensation system as we kick off this new decade. If we've learned anything during these past few months, it's the importance of being prepared. I'm reminded of this quote: "Things take longer to happen than you think, and then they happen faster than you thought they could." Well, that's never been more true than in this moment. The future always seems to be somewhere way out there in the distance until suddenly it's here. In the past, pandemics always seemed to happen somewhere far away, and a recession would be well into the next year. And then suddenly, the world seemed to change overnight. We have to be agile and respond. 2020 is a pivotal year. So I want to spark your thinking about today, but also about the decade ahead and the challenges that we face together. COVID-19 has touched all of us, but especially those who have suffered with the illness or those who have lost their jobs. Workers' compensation is being tested as never before, but we should not lose sight of the fact that our system is strong and resilient, and I remain confident that we will rise to the challenge before us. During the past 10 weeks, I've spoken with dozens of industry stakeholders. They're concerned about rapidly expanded presumption laws and their unknown impact on loss costs. They feel the reverberation of the economic shockwave, and they're looking for solutions for paving the path to recovery. However, without exception, they remain committed to the mission of our system, to create and maintain safe workplaces, and to be there for injured workers, their families, and the employers who depend on them. At NCCI, our focus is on keeping our operations strong, our employees safe, and bringing valuable perspectives and education on the most critical matters. I'm very proud of our employees. They have adapted and they've demonstrated incredible resilience through this crisis, and they've never lost focus on serving our stakeholders. Our COVID-19 Resource Center at NCCI.com has had thousands of hits. We recently published an economic briefing to help you understand short-term and downstream impacts of the crisis. And we developed and shared financial modeling to help illuminate the potential costs of presumption proposals and other changes to the system. This work is built using the hallmarks of all NCCI research. It is data-driven, it relies on superior analysis, and it's intended to promote constructive, vigilant dialogue. At a time when we're seeing widespread speculation, taking a data-driven approach sets this work apart. Now let's look at the industry performance for 2019. Yes, the financial realities have changed from year end, but here's the important point. Our system enters this crisis from a position of strength. Our workers' compensation system had another solid year and finished financially healthy at year end 2019. However, we all know that we must respond to an array of COVID-19 claims. And we know that the economic downturn has devastated payrolls in many industries and will drive premiums lower. But our system has been resilient and reliable for over 100 years, and it's up to us as stakeholders working together to see that this continues. We need to address the immediate crises, but we also need to look ahead. Once we emerge from this moment, we need to ensure that our system remains healthy for the long term. Some issues we face are evergreen: safety, technology, changing workforce, and some topics we're just wrapping our arms around, like post-traumatic stress disorder and the gig economy, and of course, public health crises. And so today, we'll consider just a couple of the key questions for the next decade. Our first question: what are the odds healthcare looks the same in the next 10 years? Or what about 5 years, or even next year? This is a Captain Obvious question, right? Particularly after what has transpired these past 10 weeks. But we must think about it. There are a lot of ways that healthcare could change, technologically, economically, socially, all of these. But make no mistake, as goes healthcare, so goes the medical component of workers' compensation. We're just a fraction of the bigger picture. If we're going to stand out and be successful, we need to be modern, efficient, and easier to do business with. NCCI will soon release a special AIS follow-up session highlighting future medical transformations. One of the topics covered is how COVID-19 is accelerating the use of telemedicine. For the payer, it will clearly lower costs significantly. For the provider, it enables higher volume and increased use of electronic medical records. And for the patient, the convenience factor. Imagine getting a doctor's appointment on time, or at least the waiting room could be on your own couch. It's just one example of rapid, radical change. As one practitioner said, we've witnessed 10 years of change in 1 week. I am confident that healthcare will look much different in the decade ahead, and I'm hopeful that workers' compensation will keep up. Understanding what we can expect will help us prepare and act accordingly. Our next question: will cost trends change? This slide shows a nearly 30% drop in loss costs during the last decade. So what are the odds that this continues? Not long ago, themes seemed to be on a predictable course. Frequency dropping steadily for years, medical costs stable, and no dramatic swings in compensability and coverage. But we've seen how things can change in the blink of an eye. Clearly, the next 10 years is going to look much different than the last 10 years. Quite frankly, the unknowns are scary. Still, I remain confident that we will navigate these stormy seas because we have better access to data, analysis, and insights. We know where to focus. We understand the heightened need for vigilance. So imagining the future and what it means for workers' compensation involves asking questions for which we don't have all the answers, or in some cases, any answers. But it also reminds me what hasn't changed. So many things that were true in 1920 remain true in 2020 and will likely be true in 2030. Our workers' compensation system must be strong, healthy, and responsive. To get us there, we must be ever watchful to stay on top of the changes to our system and our world. We must be tireless and attentive. And that brings me to our word for this year. It's vigilance. One of my favorite definitions of vigilance includes the phrase devoted attentiveness. And I like that. It means that we won't get distracted. Vigilance is hard, as we're coming to understand during this pandemic. It requires a lot from all of us. But it's critical to ensure that we are there when workers and employers and our communities need us. And we're coming at this from a position of strength. This is our opportunity to rise up to the challenge. We want to be thought of as a caring and contemporary system, providing the best support for injured workers, attracting strong, talented people to our industry. We must continue changing the language we use and changing the way we think about employers, not policies, and injured workers, not claimants. People in this industry are proud of what they do. And I believe that this is the decade, this is the moment that we can change the narrative. And there's no better example to follow than the one set by the people who are on the front lines of our effort, the people who interact with and care for injured workers every day.
Sherry Boyd, I'm a certified case manager.
My name is Marianne Dufault, and I'm director of the Major Case Unit.
My name is Cheryl, and I'm a senior telephonic nurse case manager.
My name is Marcia, and I am a nurse case manager.
Early on, right from the beginning, making that contact, it might be that the patient's unconscious, but we can connect with the family, helping them understand what's going on. We try to start that from day one just by fostering that relationship.
Our goal is to maximize their recovery and to return them to wellness.
One of the most important things is just gaining that, that trust with the family, because generally the patient doesn't have a voice at that time.
I want to establish a rapport with them, learn what makes them unique.
You know, we really are able to work closely with the injured workers and their families to get them, for example, to centers of excellence, to make sure they're getting the best quality rehab care in order to get that best outcome down the road.
I like to be available to my injured workers and to their families. They have a lot of questions, and sometimes those questions they don't come up between 7 and 3:30, Monday through Friday.
There are so many pieces in the puzzle to get people to where they need to be, to get them timely care and get the services that they need.
When you see someone in a wheelchair or you see someone with a prosthetic that has an amputation, to just remember that they're people with feelings and passions and desires.
He's a human being. He's a father. He's a soccer coach. He's a farmer. He's not just a brain injury laying in that bed.
They want a normal life just like we do. And that in workers' compensation, we help them get that.
I love it when we can change someone's mind about workers' compensation.
You know, workers' comp in the past, it was a stigma. It doesn't have to be.
In the workers' compensation system, we try to do the right thing for every injured worker. So we're working constantly to get them the most appropriate care possible.
Workers' compensation may have gotten a bad rap or may not even be considered in the past. And now we have an opportunity to show them that there are so many avenues you can go that you can help people.
But I've never really viewed it as workers' compensation, more than I've just viewed it as caring for the injured worker and for his family.
You know, when they tell you, I felt the whole way that you had compassion and that you cared for not just me, but my family. It's been more rewarding than I ever anticipated.
This is a profession where you can really get a positive feeling about what you do. I love my job.
There are so many moments that you know you're making a difference for good. And that's why we're here. That's why we're here.
So you can see why I feel strongly about our ability to change the narrative for workers' compensation. We're in a strong position to deliver for our stakeholders when they need us most. Thank you for your resilience. Thank you for caring, and thank you for being part of this important work we do together. And I look forward to seeing you in Orlando next year.
Thank you, Bill. Next up is NCCI's Chief Actuary, Donna Glenn, and our exclusive State of the Line report. At the end of today's program, I'd encourage everyone to also access our State of the Line guide as part of our AIS Highlights report, available on ncci.com. The guide is a companion to Donna's presentation and will provide you with a slide-by-slide analysis of the formulas, key takeaways, and data sources for all of the information she presents today. And now here is NCCI's Chief Actuary, Donna Glenn.
As NCCI's new Chief Actuary, I have both the honor and the pleasure to present our State of the Line to you today. Typically, we focus on last year's results and review them in great detail. Because 2020 has started with such a shock to the system, we are flexing our approach with this year's State of the Line. I'll begin by highlighting how the COVID-19 pandemic is affecting property and casualty industry, and then focus on workers' compensation and how NCCI is responding. And then we'll see the details underlying workers' compensation's strong 2019 results. And I'll wrap up with what we may expect during the rest of 2020 and these uncertain times. So we're 4 months into 2020, and it's safe to say personal and commercial lines are trending in different directions. In personal lines, the industry is benefiting from reduced driving mileage, so much so that carriers are providing premium credits to insureds for the expected frequency decrease. And homeowners, too, has benefited from a mild first 4 months of the year, with relatively few winter storms and tornadoes. On the other hand, commercial lines has far more challenges ahead. Pandemics have long been considered an uninsurable risk, and they've typically been excluded from coverage. So keeping in mind the intent of current policy language, it's not likely that standard business interruption coverage will provide any relief to businesses. And it's also possible that some businesses could face liability for the spread of the virus, and this could result in general liability and director and officer claims. Legislators are searching for solutions and leaning on insurers to bear some of this burden. And as we all know, workers' compensation is typically the most sensitive to changes in the economic cycle. So we have several unique challenges ahead. And the reality is, COVID-19 has shocked the workers' compensation system. The sudden, sweeping, and complex changes caused by the pandemic have created much uncertainty. Almost overnight, some workers find themselves on the front line, while others began telecommuting. With the unique frontline exposures, legislation impacting compensability and presumption of coverage is top of mind. Statistics on infection rates, death rates, hospital capacity, access to care are changing by the day. And at this point, we expect almost every aspect of workers' compensation to be impacted. Nevertheless, the system is strong and designed to support workers and employers. We're all in this together. NCCI, policymakers, regulators, carriers, service providers, agents, and brokers. All of us working collaboratively to weather this storm. And I have confidence that together we will rise to the challenge. And as Bill said, vigilance is key, and it won't be easy. So let's start with how NCCI is responding. These circumstances are extraordinary, and it's warranted us to consider adjustments to rules and data collection. I direct you to our COVID-19 Resource Center to review the wealth of information and guidance available to you. For example, our frequently asked questions document is updated weekly, and it addresses items such as rule changes and the reclassification of payroll. And you'll also find legislative activity and our quarterly economic briefing series, where we focus on COVID-19's economic considerations. And NCCI recently released a white paper focused on COVID-19's potential loss impacts. And the approach outlined in this paper enables us to build scenarios that assess the potential impacts of various exposure and compensability actions on losses. This tool may help policymakers, regulators, and others understand the implications of change and make well-informed decisions. The white paper, it's just a part of what we do at NCCI to evaluate regulatory and legislative changes in workers' compensation. You may find it helpful to better understand this process and learn about some other recent trends that we are currently monitoring. Here's a short video that explains laws and orders.
NCCI frequently analyzes the potential system cost impacts of proposed legislation and regulations, as well as changes to the workers' compensation system resulting from court decisions. We do not make policy recommendations. Our role is to objectively evaluate the potential impacts associated with workers' compensation system reform, ranging from targeted changes to comprehensive system rewrites. Policymakers use this information to make informed decisions, and the industry utilizes it to ensure they understand the system cost impacts of such proposed changes. NCCI completes approximately 140 system cost impact analyses each year. Several NCCI data streams are used when assessing the impact of proposed legislation and judicial decisions. Financial call data is used to estimate the share of costs associated with indemnity benefits versus medical expenses. Unit statistical plan data is used to examine indemnity benefits by type of injury. The transactional detail reported in the medical data call is used to determine medical cost distributions and examine payments in relation to maximum reimbursements. In addition, NCCI has begun collecting transactional data with the indemnity data call, which will provide greater insight into workers' compensation indemnity benefits. To supplement this collected data, NCCI also reviews external resources and may gain further insight from system stakeholders. In recent years, some of the more pronounced trends in legislative proposals and judicial decisions have related to benefit levels, marijuana, compensability, and exclusive remedy. Proposals to increase wage replacement benefits have significantly outnumbered proposed benefit reductions. In fact, in 2019, 4 NCCI states enacted increases to their indemnity benefit levels that required interim loss cost filings to reflect their impact. Legalization of marijuana is an ongoing area of activity at the state and federal levels. Courts have been reviewing marijuana-related issues in workers' compensation and the workplace. Compensability continues to be an active subject across states. Most recently, presumptions related to cancer and mental injuries for first responders have received much attention. Exclusive remedy has seen many broad-based legal challenges over the years. While some litigants have tried to narrow or expand the scope of its application, others have sought to test its constitutionality. Each summer, NCCI's Regulatory and Legislative Trends Report provides an overview of the key legislative and judicial developments based on the most recent legislative session and is available online. NCCI continues to monitor trends in these areas and examine the impact of newly emerging hot topics. Above all, we are committed to remaining the leader in evaluating the potential system cost impacts of legislation and court decisions affecting workers' compensation.
We will continue to promptly respond to inquiries regarding COVID-19 and its potential impacts. Now, let's review our 2019 results. And the 2 themes you will hear are unprecedented financial strength and consistent performance. And the system is well positioned to face the COVID-19 stress. Here you see a long-term history of workers' compensation combined ratios. And for 2019, we had an 85 combined ratio. That 85 is a 2-point increase over 2018. So this is a time of unprecedented results. We've had 3 years in a row with combined ratios under 90. And that 85 translates into a 15-point underwriting gain, significant financial strength. And we also see consistency here, with 6 consecutive years of underwriting gains. So if we break the combined ratio into its components, you can see that there's been a slight uptick in the most recent year in the bottom 2 components. Loss ratio is in blue, and the loss adjustment expense ratio is in purple. Even with the small loss ratio increase in 2019, the last few years of loss ratios are the lowest we've seen in at least 3 decades. let's look at investment gain on insurance transactions. And this comes from the annual statement insurance expense exhibit, where we separate investment gains into those attributable to insurance transactions and those attributable to capital and surplus. Our preliminary estimate of the 2019 investment gain on insurance transactions is 11%. That is higher than last year's result, but still below the long-term average of 12.6%. And overall, investment returns have been solid when you consider last year's interest rate environment. An 11% investment gain combined with a 15% underwriting gain results in a 26-point operating gain for 2019. And 26 is the largest gain we've seen going back at least 30 years, and to have 2 consecutive years at this level is remarkable. As the decade came to a close, workers' compensation finished very strong, with 7 straight years of operating gains greater than 10%. So we've been talking about calendar year results, and they are shown here in blue. And you'll remember that calendar year results include adjustments to reserves on prior accident years. So we add in the accident year results in this view, and they're shown in yellow. We do this to provide a more complete picture of the workers' compensation financial condition over time. And you can see here that the accident year combined ratio, as reported in the NAIC annual statement, is 99 for 2019. And it's increased 4 points from the 2018 accident year combined ratio. This is the first time in 10 years where results for both calendar year and accident year have worsened. Here we bring forward the accident year combined ratios from the previous slide, and you can see them on the right in each 2-bar pair. And on the left in each group is NCCI's estimate of that year's ultimate accident year combined ratio. In other words, this is the level to which we believe each accident year will develop over time. So NCCI believes accident year 2019 will develop quite favorably, falling by 9 points before all claims for that year are settled and closed. And while the magnitude of this expected improvement is sizable, it's comparable to what we also expect to occur for 2018, and to a lesser extent for several years prior to that. And if we remove underwriting expenses and dividends from the values on the previous view, we're left with the loss and loss adjustment expense ratio shown here. And for each accident year, the difference between the selected and the reported accident year values helps us determine an estimate for the reserve position for the workers' compensation industry. And here's a view of that reserve position over time. And it shows total private carrier net loss and loss adjustment expense reserve adequacy. Above the line is a reserve deficiency, and below the line are reserve redundancies. So you can see that reserves held by private carriers as of year-end 2019 are $10 billion redundant. That's despite the calendar year reserve releases. This completes our highlights for workers' compensation. Consistently strong financial position like we've seen for the past several years. We will go into more detail into the drivers of these results. But first, let's discuss how workers' compensation fits into the broader property and casualty context. It's important to put workers' comp in context with the other lines of business, as not all lines are experiencing the same steady and strong results as we've seen in workers' compensation. And we'll review premium and underwriting results. Let's start with premium. Starting at the bottom, property and casualty net written premium in 2019 is just over $632 billion, an increase of 3.2% over 2018. And the growth is fairly consistent across most lines of business. It possibly reflects a firming market across most of P&C. But workers' comp, on the other hand, dropped by nearly 3% last year. And we'll dive deeper into the workers' compensation premium shortly. So what's been going on in the broader P&C market? Let's look at CIAB's Market Index Survey. What's captured on this slide is the premium change experienced by policies renewing in each quarter. We're showing 8 quarters from first quarter 2018 through fourth quarter 2019, and it's by line of business. So in blue, you see workers' compensation premium decreases have been very consistent over this time period, ranging from -2 to -3%. On the other hand, commercial auto has seen consistent premium increases, and that market has been hard for most of the decade. For general liability and umbrella, we see an acceleration in the premium increases over the past 2 years. These are included in the prior slide in the other liability category. And premiums have increased substantially in the second half of 2019, and umbrella has reached nearly 15% in the fourth quarter. This is likely to continue into 2020. Now let's take a look at the underwriting results of the property and casualty industry. At the bottom, we see the 2019 overall combined ratio for the P&C industry is 99. It represents no change from the previous year. Across the different lines of business, however, combined ratio changes were a mixed bag. Other liability showed the largest deterioration, and perhaps this reflects the premium increases we saw on the last slide. On the other hand, homeowners and fire and allied lines improved significantly. Both are below 100. And Mother Nature has contributed her fair share to these results, with lower catastrophe losses in 2019 relative to 2018. As for workers' compensation, we already saw that the combined ratio increased modestly by 2 points to 85. But within this broader P&C context, we can see that workers' compensation had the strongest underwriting gains of all of the property and casualty lines of business. Looking at a long-term view of the property and casualty industry combined ratios, you can see that it's had its ups and downs, and in general, it hovers around the break-even combined ratio of 100. The long-term average is 102. Overall, the P&C industry has produced an underwriting profit in 5 of the 7 most recent years, and it appears that carriers have stressed the role of underwriting. Next, let's peel back the layers to better understand workers' compensation results by looking at the component parts of the loss ratios, premium and losses. And we'll start with premium. This view shows a history of workers' compensation net written premium for the last 2 decades. And the private carrier premium is shown in blue, and the state fund premium is shown in yellow. And as I mentioned, the 2019 net written premium for private carriers is $42 billion. And when state fund premium is added in, the 2019 net written premium total is $47 billion. It's a slight decrease when compared with that for 2018. Now let's take a brief look at the premium in the residual market. We'll review the cyclicality in the residual market premium over time. So premiums grew after 9/11, then declined significantly during the late 2000s, and increased again after the Great Recession. Through the years of strong workers' compensation profitability, the residual market has been very stable, and the volume is an indicator of a healthy workers' compensation system. It signals that risks are continuing to find coverage in the voluntary market. In NCCI service pools, premium has been hovering at about $1 billion over the last several years, and you could see small year-over-year declines since 2015. So time will tell. The impacts of COVID-19's deep employment contractions and broad compensability actions could impact the size of the residual market. If we look at residual market share over time, you can see that 2019 is estimated to be approximately 7%. And this is a continuation of the recent decline. And it's a manageable size from a countrywide perspective. Ensuring that the residual market is self-funded remains one of NCCI's core objectives. And to date, all metrics are pointing in a good direction. Now we're switching back to the total workers' compensation market for private carriers to look at direct written premium. Countrywide direct written premium declined slightly between 2018 and 19, with a slight change of minus 2.6%. It's very similar to the change in net written premium. And over the next few slides, we're going to discuss the primary contributors to this decrease, including state differences, payroll levels, and loss cost levels. We'll start with direct written premium changes by state. And you can see here, there's quite a bit of variation. The jurisdictions in shades of blue saw direct written premium increases, and those in orange experienced direct written premium decreases. And it shouldn't be a surprise that most states are in some shade of orange, as generally decreasing loss costs and rate level changes have been approved across the country. Now we'll focus our attention on the NCCI jurisdictions. And at the bottom of this slide, you see the private carrier change in direct written premium was minus 1.3% between 18 and 19. Changes in payroll and other factors only partially offset the downward impact on premium due to the changes in bureau loss costs and mix of business. Let's review the change in payroll on the top line in more detail. You'll notice the change in payroll on this slide is slightly different than the one on the previous slide. And that's because we're now using the detail from Moody's forecasts to help explain the changes in the components of payroll. So changes in payroll can be driven by changes in wages or changes in employment. And both of these increased in 2019. But wages on the left grew at a faster rate than employment on the right. On the left, the white vertical line marks the overall average wage change of 3.7%, and there were wage increases across all economic sectors. And on the right, we see employment grew by 1.5% during 2019, with the construction sector leading the way once again this year. The next driver of the overall premium level change is the change in bureau loss cost levels. And this chart shows the impact of approved NCCI rate and loss cost filings on bureau premium level. It's reflected here by effective year. So while the weighted average decrease has been close to 10% for 2018 and 2019, the 2020 average decrease is not as large. It's approximately 7%. And when you look at the most recent round of experience filings by individual jurisdiction, you'll notice there are no increases. In addition, the range of filings became tighter, with fewer states experiencing double-digit decreases in the most recent rate filing season. Now let's turn our attention to drivers of workers' compensation losses, and we'll begin with frequency. Here we see the annual changes in lost time claim frequency over the last 2 decades. And on the right in blue, you can see NCCI's preliminary estimate for 2019. The annual change in claim frequency is minus 4%. And this is consistent with the long-term average annual decline of 3.8%. Recall in 2018, we saw a relatively smaller decline in claim frequency. It was approximately 1%. And many were questioning whether that was a signal of a possible cycle turn. And based on these frequency results alone, it doesn't appear that we've reached a turning point. So here's a video that highlights some of the key drivers underlying this long-term decline in claim frequency.
Workers' compensation claim frequency is calculated as the number of claims relative to some exposure base. This key metric is a common topic of conversation in workers' compensation circles. For nearly 100 years, the rate of workplace injuries has gradually decreased, putting downward pressure on total workers' comp system costs. However, there have been historical periods during which claim frequency changes have broken away from this long-term downward trend. When will the next period of increasing claim frequency occur? Will it be a temporary blip like we saw after the last recession, or a more prolonged, substantial reversal of the long-term downward trend? No one can know for sure, but we can gain insight by considering the factors that have contributed to the long-term claim frequency decline and the short-term breaks in that historical trend. NCCI research has shown that claim frequency has declined over the long term across every major category: gender, age, industry, and type of injury, to name a few. Several factors have contributed to this widespread pattern. Global competition has motivated employers to improve working conditions and productivity, the byproduct of which is safety. Risk management resources have partnered with human resources to create holistic approaches aimed at improving worker safety and overall worker wellness. Risk management is focused on managing the safety of the environment and mitigating hazards, whereas wellness programs target overall worker fitness and illness prevention. Together, these efforts have contributed to improved workers' compensation claim frequency. The format of occupational training programs has also been revised to improve their effectiveness and ensure employee safety. For example, employees who work at heights can utilize virtual reality training to gain experience without the risk. Automation and technological advances have also contributed to the decline in claim frequency. Over time, automation has facilitated a general shift in employment from farming and manufacturing to generally safer service-based industries. Technological advances, including the use of robotics, artificial intelligence, and wearables, have also helped to reduce the number of workplace injuries. Over time, there have been short-term changes to the long-term pattern of declining claim frequency, most commonly during and following recessions. NCCI research has shown that, during recessions, shrinking employment tends to put downward pressure on overall claim frequency, as the newer and less experienced workers are most likely to see their hours reduced or eliminated. As the economy recovers, the opposite occurs, and claim frequency tends to rise. Of course, changes in claim frequency vary by individual company due to differences in their books of business, including the types of risks they insure, industry sectors to which they offer coverage, varying underwriting guidelines, and the fortuitous nature of the insurance industry in general. NCCI has and will continue to engage with industry stakeholders to remain a thought leader on this key cost driver in the workers' compensation system.
As the video described, frequency has declined over the long term across every major category: gender, age, and industry. Let's explore a few other dimensions in more detail to see if there are any deviations from this overall long-term decline. And here you see the average annual frequency change by nature of injury. This view captures frequency change from 2013 through 2018, and the size of the circle represents the number of lost time claims. So we've highlighted both sprains and strains in blue, and these have had relatively larger average annual declines when compared with the average across all claims, and that's shown in yellow. Together, sprains and strains make up about 40% of all lost time claims. And as you can see, average declines were observed across all nature of injury categories. Now let's look at another dimension. Using the same setup, but drilling down into part of body, we see a common theme of general decline in lost time claim frequency. And on the left, back injuries have seen the largest average decrease in frequency, which is almost double the all claims average of -3.8%. And this indicates that companies have made great improvements in lifting techniques, enforcing weight limits, and other safety measures to minimize the strain on the upper and lower back. On the right side of the chart, head, brain, and face was the only part of body category to experience an increase in frequency over this same time period, with an average increase of 1%. Although this category has a fairly small number of claims, it does include TBIs, traumatic brain injuries. These injuries tend to be more severe and can result in permanent impairment. And since it's a departure from the overall decline in frequency, we will continue to monitor these results. As we've shown before, motor vehicle accidents have also deviated from the long-term claim frequency decline, and they continue to do so. The gray line at the bottom of this chart shows a cumulative decline in frequency for all claims, and the blue line shows a cumulative change in frequency for motor vehicle accidents alone. So while the overall claim frequency continues to fall, the difference between it and the cumulative change in frequency for motor vehicle accidents continues to widen. And at the end of 2018, approximately 80% of U.S. adults owned a smartphone, a significant increase from the corresponding 20% figure at the beginning of 2011. Distraction related to these devices may always be a factor in motor vehicle accident frequency. And safety mechanisms like hands-free Bluetooth do not appear to be helping motor vehicle accident frequency. So there are a few departures from the long-term frequency decline that warrant some vigilant monitoring. Moving to claim severity, let's start with indemnity. And this view provides average indemnity claim severities over time. And the percentages at the top of the bars are the average annual changes, and the values in the bars themselves represent the average cost in thousands of dollars. Our preliminary estimate of the 2019 change in indemnity claim severity is an increase of 4% to approximately $25,300. And this 4% is in line with the projected countrywide average wage increase. And it's only slightly higher than the prior year's annual change. If we connect the tops of the bars, you see the cumulative change in indemnity severity. It's shown here in blue, and it's indexed back to 1999. In yellow, for comparison purposes, you see the cumulative growth in wages over the same time period. So since 1999, indemnity claim severity in NCCI states increased 85%. And this is almost fully explained by the 78% increase in underlying wages over the same time period. Now let's turn our attention to medical severity on lost time claims. Here we see the average medical claim severity over time, and our preliminary estimate of the 2019 change in medical lost time claim severity is an increase of 3% to approximately $29,500. And as we connect the bars again, you see the cumulative change in medical lost time claim severity. This time we're comparing it to medical price inflation, and that's shown in yellow. So our proxy for medical inflation is the Personal Healthcare Chain-Weighted Price Index. In NCCI states, medical lost time severity has grown more than twice as fast as medical price inflation over the last 2 decades. And much of that growth occurred in the first decade shown. Over the second decade, changes in medical lost time claim severity have more closely tracked the growth in medical care prices. This completes our review of the 2019 results. As a recap, the workers' compensation system has been financially strong in the last 6 years, with an unprecedented duration of profitability. Favorable combined ratios and a strong reserve position indicate that the system is well positioned to face the uncertainty ahead. While we have an abundance of questions and only a few clear answers, let's discuss how COVID-19 may potentially affect the workers' compensation system. And we expect that workers' compensation results will be impacted in 2020 and likely farther into the future. So let's jump in with employment levels. It is very clear that big industry segments are experiencing harsh declines. As you can see on the left, workers in leisure, hospitality, and travel-related industries. Think of restaurants, hotels, and cruise lines. They're feeling the brunt of the economic downturn. And the same is true for many manufacturers and distributors as customer demand has declined. On the other end of the spectrum, there's strong demand for healthcare for urgent needs. It's tempered by layoffs at some facilities. There's also high demand for grocery workers and home delivery. But many of these new jobs may be temporary. And in the middle, telecommuting has helped stabilize employment in the professional services sector. Make no mistake, the shutdown cuts deep. Since mid-March, we've seen more than 30 million claims for unemployment. The biggest unknowns will be the duration of the shutdown and the resiliency of businesses and sectors to recover. It's clear that such a dramatic drop in employment will push premium volume lower in 2020. Lower employment and fewer available work hours will reduce workers' compensation exposure. Small businesses have been especially hit hard by the pandemic, and given that they typically choose first dollar workers' compensation coverage, we expect workers' comp premium to fall even faster than the overall employment. We also expect to see lots of midterm premium adjustments and negative premium audits to reflect this reduced exposure. On the right, some carriers have suspended policy cancellations and late payment penalties. So this doesn't change premium levels, but it does provide additional timing flexibility to policyholders. Let's consider claim frequency. On the left, we see a couple of reasons why we can expect claim frequency to decline in the near term. With access to care limited, there may be a deferral in the number of claims filed. For example, non-acute injuries may have a delay in reporting since the treatment can be postponed. Higher unemployment levels may also put downward pressure on claim frequency. Employees may choose to work through minor injuries rather than submitting a claim. And on the right, there's potential for increased frequency. Frontline workers are susceptible to contracting COVID-19. Changes in policy on compensability, both broadening and presumptions, are likely to put additional upward pressure on frequency. In the middle of the slide, the impact is less clear. Less driving and more telecommuting may reduce the number of motor vehicle accidents. But with people working remotely, in spaces not designed for work, we may see more ergonomic injuries. Let's consider claims severity for existing workers' compensation claims. On the right are key reasons to expect upward pressure on claim severity. For example, as elective treatments and non-acute care get delayed, it may extend claim durations and put upward pressure on costs. Workers may also find fewer return-to-work opportunities during the pandemic, and light-duty programs may be less available, and these may lengthen the time period for workers' compensation benefits to be paid. On the left, telehealth is being widely used. With reduced expenses associated with a telehealth visit, this may help average claim severity. Let's look at COVID-19 workers' compensation claims. What might they look like? Hard data is extremely limited, but it will become clearer once we see actual claims. At the top left with indemnity, it's reasonable to expect a range from a day or two away from work to significantly more time away, weeks or even months. On medical on the right, COVID-19 claims are likely to vary widely in severity. Some may require relatively low-cost medical care for mild symptoms. However, severe cases involve extensive treatment plans, including hospital stays, intensive care, and ventilators. And some may even result in the need to manage a lifelong medical condition. It's also possible that claims may involve only a mental component and require temporary or long-term care. So over the coming quarters, we will begin to learn more about the characteristics of COVID-19 claims. 2020 has proven to be life-altering for all of us. It's also system-altering for the workers' compensation industry. We must remain vigilant and confident, and we know the workers' compensation system is well-positioned to face uncertainties. Here's what we know. we can expect workers' compensation premiums to fall, and they'll fall significantly as unemployment rises. And we will also see shifts in claim frequency and severity. And there are changing rules and the potential for expanded compensability for this virus could drive up costs significantly. NCCI is monitoring all of these changes, and we will remain vigilant and will continuously share our analysis, insights, and guidance. Similar to past years, we are providing all of the materials presented here in our usual State of the Line guide. Since this virtual experience is abbreviated, you will find additional information there as well. And you'll also find timely updates on our COVID-19 Resource Center. All of this is conveniently located on ncci.com. Thank you for your interest in our State of the Line discussion today. We are anticipating your questions, so please tune in to our Meet the Expert session later today. Personally, I'm thankful for so much these days. My health, my family, my friends, and being part of NCCI. My team and I are committed to weathering this storm with and on behalf of the workers' compensation system. And I share Bill Donnell's confidence that the workers' compensation system will rise to the challenge created by this pandemic. And it is indeed a challenging moment, but we will fulfill our purpose to support injured workers and all of our stakeholders to ensure a strong, healthy workers' compensation system.
Thanks, Donna. Our final speaker this afternoon brings with him a unique perspective on our economy, our larger industry, and specifically workers' compensation. As a current educator, former director of economic research here at NCCI, and the former president of the Insurance Information Institute, Bob Hartwig's range of experience and insight are particularly valuable in times of change. Bob has a lot to say about our economy's outlook and, of course, the impact of COVID-19 and what it means for workers' compensation. Joining us from his home in South Carolina, here is Dr. Robert Hartwig.
Thank you, Mark, and thank you everyone for joining us at AIS 2020, the virtual edition. To say that we're living in unprecedented times and that there are unprecedented challenges facing the workers' compensation line is a refrain we've actually heard before at prior AIS gatherings. That was certainly the case after 9/11, and it was certainly also the case during the Great Recession more than a decade ago. But through each and every one of those events, the workers' compensation line has persevered. Now, it's my great pleasure today to be able to bring to you a detailed analysis of the economic impacts of the COVID-19 pandemic, the challenge of our day on the workers' compensation line and on the property casualty insurance industry.
I'm going to provide you with an outline of my presentation where we are going to be discussing a variety of issues impacting property casualty insurers, but of course focusing on the impacts of coronavirus, COVID-19, and the impacts on the P&C insurance market and the workers' compensation insurance industry. Now, we're going to begin with a brief overview of the P&C insurance industry overall and take a look at its financial performance. And we'll see that the industry has entered the COVID-19 pandemic period from a position of financial strength, and that's a great thing. We'll talk about COVID-19's potential impacts on key lines. We'll talk also about the extraordinary volatility we've seen in investment markets so far this year, much of that also due to COVID-19 and the pandemic. And then, of course, the economy and the labor markets, which are extremely important to workers' compensation, the labor markets in particular, and some federal and state initiatives that are also important to commercial insurers and workers' comp insurers in particular. And then we'll summarize with a few conclusions at the end. Now, when we think about the P&C insurance industry, we all know that it's a very strong, stable sound, and secure business, whether we're talking about being able to pay catastrophic losses from natural disasters. This is certainly another sort of disaster, one we have not really seen in the history of the industry. And what we could see is that we ended 2019 with a record $858 billion in policyholder surplus. There was a lot of volatility in the markets during the first quarter, so we've dropped down to an estimated $775 billion, but the industry is still very strong, stable, sound, and secure, and prepared to pay whatever claims are necessary associated with policies that have been purchased by policyholders. And I'm making that distinction because there are some issues in terms of some types of entities making claims on the industry's surplus for coverages which simply don't exist. Now, we'll talk about that later on. Now, the industry had finally restored itself to a similar level of profits and profitability as it had seen prior to the financial crisis. However, certainly we expect net income after tax, in other words, the industry's profits, to fall as a result of the COVID-19 pandemic for a variety of reasons that we'll discuss soon. Now, the question is, how much might it fall? Obviously, we've entered a recession, and it's typically the case, if we examine history, that we see a drop-off of about 4.5 points in terms of the industry's ROE following major economic declines. During the last economic decline in the financial crisis, the industry's return on equity, ROE, fell by about 8 points. And we can see historically by examining economic downturns over the past half century, again, as I mentioned, the approximate decline in ROE is about 4.5%. The median is about 5%. And we would certainly expect that this time around. Now, the bigger question for many is what is going to be the impact on premium growth? With the economic slowdown, there's certainly going to be a substantial impact. Pre-COVID, the outlook for 2020 was for overall net written premium growth of 3.8% across the industry. Now it is very much a question mark where we will wind up in 2020. I am attempting to look at history here to see if there are any answers, just as I did with the ROE, but history doesn't really provide much in the way of answers in terms of what might happen to premium growth after economic downturns. As it turns out, we've seen periods in which there was growth and where there was decline in terms of premium changes on an annual basis in the P&C insurance industry. So on average, after economic declines, during and after economic declines, we've seen essentially no change. So history doesn't tell us anything. However, we do know that this event, the COVID-19 pandemic, has created an economic tsunami that has erased huge amounts of exposure from the industry. It's dramatically slowed down the economy overall, and as a result, I am certainly expecting to see a decline in growth in terms of all lines P&C and of course personal and commercial lines as well. And I expect commercial lines to be more severely hit. These are very, very rough ballpark estimates. We have many months left to go in the year. Much can happen, and much depends on the pace of recovery from the pandemic and the pace at which states reopen. And if I do take a look at some evidence that we do have, some initial analyses that have been done for a few key lines from a recent Willis Towers Watson analysis, for example, they have estimated that workers' compensation could potentially see 12.5% to 25% reduction in premium written. Again, a wide range, and it depends on the pace of the recovery and the depth of the recession itself. And you can see the declines in several other key lines, and these are multi-billion-dollar declines for the most part. So there will be a substantial impact on the overall property casualty insurance industry growth rate this year. I still expect it to be slightly positive, but it is possible it could move into negative territory. From an underwriting perspective, the industry was actually in a relatively sound position. As you already heard from Donna, the combined ratio last year overall was 99. That's pretty good. And of course, this year, it's very difficult to say where we will wind up. We've yet to move through hurricane season, wildfire season. And again, of course, we do not know the ultimate effects of the COVID-19. If you do again look at the limited analyses that are available here, the two areas where there's likely to be the most significant impacts are again workers' compensation and also business interruption and contingency, which means such things as event cancellation. And of course, focusing just on the U.S. business, where we could see is workers' comp, the losses are potentially the largest. However, for the most likely scenarios, the optimistic and moderate scenarios in terms of the severity of the pandemic, we see the larger losses in the area of business interruption. So it's only in the most severe scenarios where the pandemic essentially rages on virtually uncontrolled for an extended period of time where workers' compensation would see the more pronounced losses. But there are many ways to think about what might happen to workers' compensation. One would be to look at the expectation of what would happen, say, in the transportation sector. Many workers' comp injuries are associated with truck drivers and other individuals who drive for a living. The expectation is that even under the optimistic scenario, we'd see commercial auto claim frequency fall by about 12%, and in the moderate scenario by about 23%, and fully by a third in the pessimistic scenario. This means there are likely to be fewer workers' comp injuries originating from these particular occupational classes. And it also depends not only on what we expect for an annual basis, it depends on the pace of the recovery once again. So again, this is commercial auto claim frequency, and we could see under the optimistic scenario by year-end 2020, there's virtually no change in commercial auto claim frequency. So the effects are essentially transient, and that would be true for workers' compensation claims originating from this sector. On the other hand, in even the moderate and the pessimistic scenarios, there are lasting effects, and we would expect to see continued downward pressure on workers' comp claim frequency coming from this sector well into 2021. Now, I had mentioned earlier that it's been an extraordinarily volatile year on Wall Street. That volatility is going to increase. So what does that mean for P&C insurers? Well, again, the industry had restored itself to reasonable levels of investment income, actually getting back and exceeding its pre-crisis levels for the first time in 2018 and 2019. The COVID pandemic is going to put a damper on that. The reason why that is going to happen is because the Federal Reserve, in order to keep the economy afloat, it has radically reduced interest rates, essentially short-term interest rates back down to zero, just as it did during the financial crisis. So even as the yield on the P&C insurance industry's invested assets began to come back up in 2018, it's begun to come back down again. And that downward trend in interest rates is very, very visible if we look at both short and longer term yields. Here we could see a dramatic drop off in interest rates in the last several months. And again, we would expect those interest rates to remain depressed. There's also been a lot of volatility on Wall Street. In 2019, the S&P was up about 29%, but at one point during the height of the volatility associated with the COVID concerns, the market was down by about a third. So it's made a pretty extraordinary recovery, and April 2020, in fact, was the largest monthly gain in the S&P since 1987. It's up about 30% from its March 23rd trough. So the question is, has the market gotten ahead of itself, given that GDP growth in the second quarter is expected to shrink by 22% and the unemployment rate is going to exceed 15%? We, not that long ago, just in March, saw the largest drop ever in the Dow Jones Industrial Average of over 2,000 points, or about 8%. So truly extraordinary volatility we have seen very, very recently. And it's not over. It's going to continue. So the markets do seem to be anticipating more of a V-shaped recovery, perhaps more stimulus, an expedited vaccine, or some combination of all of those. So to summarize what's been going on recently as companies have been announcing their first quarter 2020 earnings, these are some of the first numbers we actually can assess and review in terms of what insurers themselves think the impact of the COVID-19 pandemic is. Now, mind you, these are just first quarter results, so insurers really don't see too much impact on their books yet, though there's more certainly to come. But we've had more than 20 insurers and reinsurers report, and what we've seen is some very large losses being reported associated with COVID-19, essentially establishing reserves. Many companies have reported they expect their losses to exceed 100 million, 200 million, 250 million, and some companies, particularly larger foreign domiciled companies for whom the U.S. is a large market, close to $500 million. So it's going to be very large number all told when all companies report in the first quarter, and certainly would expect to see more in the second quarter. Many companies are also reporting realized investment losses from the chaos on Wall Street during the first quarter. However, we would expect some of those to be offset with some improvement in the second quarter, assuming that the markets continue to stabilize. Now, let's talk about the economy. This is really the major issue that's affecting us today in terms of the impact on the P&C insurance industry and workers' compensation. Unfortunately, the longest business expansion in U.S. history ended in February of this year after 128 months. The good news is that recessions typically only last about 5 to 7 months, and we're expecting about a 22% decline in GDP in the second quarter on top of a nearly 5% decline that we saw in the first quarter of this year, before starting to see the economy recover in the second half. When we look at the GDP report and unpack it a bit, what we see is that consumption, which accounts for about 70% of spending in the U.S. economy, was down nearly 8%. Domestic investment, meaning spending by businesses, was down about 5.5%, and exports plunged, exports and imports, by about 9%. Government spending was about flat. So that translates into some terrible numbers. Again, down about 5% in the first quarter, but this is nothing compared to what we see when the second quarter numbers come in. When we look at this, I think it's obvious to many people, but this chart really shows how closely tied GDP growth is, the pace of the growth of the economy on an annual basis, on a quarterly basis, and looking at direct written premium growth in the P&C insurance industry. And you could see they're pretty tightly correlated. And so I'm forecasting out very loosely at this point, but we would expect to see pretty substantial declines in both as we move through the remainder of 2020. Now, obviously, payroll is extremely important to workers' compensation, being the exposure base. You can see payroll proxied here by wage and salary disbursements in the economy, making a fairly steady charge upward ever since the recession. We could see workers' comp trending downward a bit, not so much because of weakness in the economy in 2018 and 2019, but because of the fact that rates have been going down. But what we will see is this curve will bend for wage and salary disbursements payroll as the data become available for 2020. So we'll see them both move down in tandem very quickly as the year moves on. Now, what about COVID-19 and its impacts on labor markets? This is really where the rubber meets the road in terms of workers' compensation, and we'll talk about some regulatory issues as well. Now, unfortunately, the tragedy here is that some 33.5 million people have filed for unemployment since mid-March of 2020. So that's extraordinary. This shatters all previous records. This means that 18% of the pre-COVID labor force has filed for unemployment, and we could see that the number of people filing for unemployment on a weekly basis shatters all previous records. Every week since March 21st, we've seen numbers that well exceed the prior records, which were set way back in 1982, as well as during the financial crisis in 2009. The huge surge in initial claims for unemployment has naturally resulted in an enormous increase in the unemployment rate. In April of 2020, we saw the unemployment rate nationally surge to 14.7%. That is the largest number we have seen in many, many, many decades. And we could see, again, just as recently as February, we were at near 50-year lows of 3.5%. So this is really a national tragedy for American workers. And so looking ahead on a quarterly basis, we expect to see about a 15% average unemployment rate for the second quarter, before only slowly making its way back down through the remainder of 2020 and through 2021. And in fact, by the end of 2021, we would still expect to see unemployment rate around 6.5%. And from the most recent unemployment report in April, what we could see is that 14.7% unemployment rate, that's the result of about 19.5 million people actually losing their jobs in the private sector alone. There were another million or so who lost it in the government sector. That is a decline in the workforce, of the private workforce, of about 15% in the span of simply 1 month. Again, truly extraordinary. In terms of the job losses, in terms of the Great Recession, we have seen versus the Great Recession, we can see that unemployment insurance claims, as I mentioned, total 33.5 million now, which simply erases all the jobs created since the Great Recession, all 24 million of them. And we could see that this simply dwarfs the number of jobs lost during the Great Recession, which was about 9 million. So what we've seen is far, far more severe. What we can hope for, however, is a swift recovery. There are other labor market impacts that are very important as well when we think about exposure. Not surprisingly, the early data show a reduction in the number of hours worked, and we would expect this to plunge as much as it did during the financial crisis, if not even more. So this obviously reduces exposure because it directly reduces the amount of payroll. The average hourly wage of private workers continues to rise, but we would expect that to be tempered as a result of COVID-19. Although ironically, in the early stages, because so many low-wage workers lost their jobs, it's higher-wage workers who are left in the labor force. So ironically, we could actually see a jump in these figures before overall seeing them flatten out a bit for an extended period of time with so much slack in the labor market. Now, so the average change in wages, you could see, was moving up nicely. Pre-COVID, it was up about 3.3% into early 2020, and this was on the back largely of lower wage workers who are making wonderful gains, and for a variety of reasons, including more and more states increasing minimum wages, but also a very tight labor market was helping them see wage growth that they hadn't seen in many, many years. Again, this will all slow down. So unfortunately, the number of people who are going to be hired is going to slow dramatically. You can see it already beginning to flatten out at the end of this series. These are the latest data available. They lag behind by a couple of months. So we're going to likely see a 20, 30, 40, 50% drop at least in the number of people who are hired through the remainder of 2020, and it could take a bit longer than that as well. The labor force participation rate is already beginning to drop off. We expect people to essentially drop out of the labor force as a result of economic tough times. We saw that trend accelerate after the Great Recession. It finally stabilized and was beginning to come back a little bit, but labor force participation is likely to drop to some of its lowest levels actually since the 1970s. The number of unemployed persons per job opening had descended to just 0.8 job seekers for each job opening. So it really was a workers' market out there. People could quit and find a job very quickly. This is going to soar as the data come in throughout the remainder of 2020. And just to take a look at the Great Recession, what might be in store. At the height of the Great Recession, there were 7 people seeking a job for every 1 that was open. So we've come a long way, and unfortunately, this is going to be a huge setback for workers. Now, a couple of other things I want to continue with here and to in fact close with. I want to discuss a couple of important issues related to the regulatory and the legislative environment and some other challenges the industry is facing as a result of these, apart from the economic challenges that I've discussed. And I'm going to focus on business interruption claims as well as workers' compensation. Now, whenever there are major events, we tend to see a lot of regulatory activity, and we are seeing a lot of claims. In fact, insurers have received tens of thousands, if not hundreds of thousands of claims related to COVID-19. Some related to workers' comp, but most are actually related to areas such as business interruption and some with respect to GL. Obviously, things more minor lines like travel insurance, some specialty lines like event cancellation, and also D&O. But each crisis tends to precipitate efforts to stretch contract language beyond the four corners of the contract. There are efforts by trial lawyers and others to find coverage where none exists, to find coverage where none was intended, and to find coverage where no premium was paid. This was true after Katrina, for instance. This was true after Sandy, and it is true with the COVID-19. Now, politicians frequently pile on here because there's zero political risk for them to do this. Now, where we've seen most of the press, initially anyway, has been the area of business interruption. This is an area where the industry is very, very concerned. There are efforts here to create coverage where, in fact, none exists at all. Now, as you know, businesses across the country have been shuttered. They've been shuttered largely by a government authority. Most business income interruption policies contain language that in order for business interruption claim to be compensable, there has to be some direct physical loss or damage to property, and it has to be the damage has to be caused by or the result of a covered cause of peril. So insurers have insisted that there is no physical loss or damage, that largely it is actions of government or fear of contracting the coronavirus and COVID-19 that has caused many businesses to close. And beyond that, the majority of business interruption policies in the United States do contain a virus exclusion. And despite this fact, some states have tried to override these exclusions, truly extraordinary legislation that would simply ignore the long-standing language that has existed in these policies and that has been approved by regulators in all 50 states. This is a clear violation of the Constitution's contracts clauses, which reads, "No state shall pass any law impairing the obligation of contracts." So I think ultimately the efforts with respect to attempting to get insurers to pay business interruption losses with respect to virus-related issues will fail, not only on constitutional grounds, but on the sheer magnitude of the demand. A nice analysis has been done by the APCIA, which shows that, for instance, for just to pay business interruption losses for small businesses, those with fewer than 100 employees, the losses could range up to $431 billion a month. If we include businesses up to 500 employees, it's nearly $700 billion a month. Compare that against a total industry surplus of about $800 billion. What this would mean is that the industry would be insolvent within the span of a couple of months. So clearly the demands are outrageous in the sense that these are losses that insurers never intended to pay. They never collected a premium for it. They're clearly excluded, and pandemics are clearly an uninsurable risk. Now, in terms of workers' compensation, there are clearly some pressure points here. Of course, you heard a lot from Donna and from Bill on this issue already, and so I just want to make two final points on this. Now, there's no question here that workers' comp written for COVID-19 exposed risks such as hospitals, first responders, nursing homes will likely see a spike in both severity and frequency. And many states will also require workers' comp insurers to cover the cost of precautionary quarantines. However, a big question is arising with respect to the impact of other so-called essential industries such as grocery stores. And the definition of essential workers varies from state to state. Now, we'll get to that in a moment, but there's no question that outside of the COVID-19 exposed segments, such as healthcare, for instance, some segments of healthcare, we would expect to see a large, swift drop in payroll exposures. Again, we're talking about tens of millions of people who have lost their jobs. There's no way that this can go other than to see a very substantial decline in payroll exposure. And as we heard already, that could be between 12 to 25%, depending on the severity and the duration of the pandemic. Wage growth, as I mentioned, is also going to slow. So AIS 2021 is going to be a truly extraordinary meeting as well, because we're going to have all these results before us to see what the impacts of these unprecedented events are. Some analyses that have been done on this indicate that certain sectors are going to be more impacted than others. When we take a look at the potential annualized premium impact. Okay, so keep in mind these are annualized figures. We don't expect the pandemic to last an entire year, but these figures nevertheless represent what would happen on an annualized basis. For instance, we would expect to see work as much as nearly 60% of the premium lost from hotel, motel, and food services, about 28% lost from retail, about a quarter lost in professional and technical, and you can go on down the line here. Some highly skilled areas such as information, we don't see much in the way of change, but we're talking about extraordinary losses in terms of premium from various segments of the economy. Now, some other concerns, and really this is the final concern, is going to be the issue associated with the expansion of the presumption of COVID-19, the disease being contracted in the workplace. So we've seen a couple of states expand presumption beyond frontline workers, such as healthcare workers and first responders. We've seen this in Kentucky, which extended it to daycare, grocery store, and postal workers. In mid-April, we saw Illinois extend it to a very long list of workers that you can see here. This was challenged by a number of associations, not insurers, but small business associations in Illinois, and ultimately a judge issued a restraining order, and the Workers' Comp Commission in Illinois did withdraw its rule. However, it's believed that the governor is going to try to pressure the commission into instituting a new similar standard. And very recently, we saw California just on May 6th, where Governor Newsom signed an order essentially allowing all employees across California to apply for workers' comp if they contract the coronavirus with an automatic presumption that it was work-related. This is truly extraordinary. This is going to be backdated all the way to March 19th and is going to remain in effect all the way out into the early part of the summer. And what the WCRIB in California has estimated is that the cost of this could range from $2.2 to $33.6 billion on an annual basis. Just the midpoint of their analysis, $11 billion, is equal to 60% of total pre-COVID California workers' compensation costs. So truly extraordinary. This is one of the major concerns that workers' compensation insurers have today, is the expansion of the presumption of having contracted COVID-19. So let me summarize. The industry is strong, stable, sound, and secure. It was that way before it entered COVID-19, the pandemic. It is that way today, and it will emerge strong as well. The rapid slowdown in the economy, however, is going to be especially painful for economically sensitive lines, especially workers' compensation, which is quite likely to be the hardest hit of the major lines because of its exposure to payroll risk. Asset price volatility is going to continue, and low interest rates are going to be with us for years to come. And so at the end of the day, the COVID-19 exposures are very substantial indeed, and in many ways unprecedented, yet this industry is an industry that always perseveres, and these risks are manageable. Clearly, however, there's going to be headline risk, particularly on the business interruption and workers' compensation presumption issue.
Well, there you have it. That's my whirlwind tour through the impacts of the COVID-19 pandemic on the workers' compensation line and throughout the property casualty insurance industry. Once again, to say that the impacts are extraordinary and unprecedented is an understatement. We have a lot that we've yet to learn from this pandemic, but we certainly have lessons that we're going to hold for the future. So let me turn it back to Mark, and thank you once again, everyone, for joining AIS 2020.
That ends our AIS Virtual program. We hope to see many of you in person in Orlando next year for AIS 2021. Thank you, and everyone, please stay healthy and safe.